Good morning. It's Jeffrey Christian of CPM Group. Welcome to the 2025 Gold Yearbook launching. I'll be joined with Rohit Savant, who's our main author and primary precious metals analyst, and Carlos Sanchez, also another partner of ours, will be working with us too. We want to start by saying that the report will be released probably today. There may be some mechanical issues and it may be released tomorrow, but probably we'll get it out this afternoon. There's a couple little changes we need to make to the ebook. There are questions. We have gotten more than 80 questions in advance of today, sent in early. And then you can also ask questions in the question thing. There's on the control panel, there's a section for questions, and you can type in questions, and Carlos Sanchez will pay attention to what those questions are. And at the end of the presentation, we'll open it up for Q&A. And you can add questions as we go if we say things that are not clear. And we'll go until we start seeing people leave in droves. We want to thank the sponsors and partners. These are companies that help underwrite the silver, gold, and platinum yearbooks every year. These are our sponsors and partners for the Gold Yearbook. We have the Bulgarian Mint, major manufacturer of precious metals investment products. Fortuna's Silver Mine, which is, I believe, now rebranded as Fortuna Mines, because it probably gets more revenue from gold than it does from its silver mines, having purchased several gold mines in recent years. GBA Group, which is a new sponsor to this, is formerly known as Gold Bullion Australia. They have acquired several new companies within Australia over the last year or three, and they're rebranding themselves as the GBA Group. Institute of Scrap Recycling Industries, which also has been rebranding itself. Kitco Metals, a longtime collaborator with CPM Group. Corlin Economics Report, a group that we work with, presenting monthly updates on our market views online. Metallic Minerals, which is a company that has a variety of exploration companies under its umbrella. Actually, each separate companies with platinum, silver, copper, and gold exploration properties. Monex Precious Metals, a longtime collaborator. I mean, Lucia Arbini and I probably met each other in the late 1980s. And we work with the third generation of Curabinis running Monex Precious Metals, one of the major precious metals retailers in the United States, and Sabin Metal Groups, major refiner of precious metals, primarily PGMs and silver. In China, we have the China Gold Association, China National Gold Group, and Beijing Yicheng Technology as companies that are partnering with us. They translate our report into Chinese and distribute it within China. In addition to that, we have media partners, Glacier Publishing, Kitco Media, and Metals Daily, and the Prospector News. Prospector News we do quite a bit of work with. And then we have distributors. They're not media partners, they're not sponsors, but they are companies that we work with. Gold Blocks, Gold Silver Central, PTEIE, and Southeast Asia Consulting are collaborations among each other in Singapore. Interact, and again, Prospector News. So we work with all of these companies, and we're grateful for their support and assistance in bringing a low-cost, very accurate, unbiased report. We don't market precious metals. We market research and consulting services. People pay us to be right. Turning to the presentation today and the markets, I'll talk a little bit about gold prices and where we think they're going, and some of the key issues that we have seen come to the fore uh, over the course of 2024, early 2025. Then I'll kick it to Rohit Savant, who will run through investment demand and other fundamentals like supply and fabrication demand and central bank activity. There's a lot of misinformation and disinformation circulating the gold market. There always is. It seems like to us that maybe there's a little bit more this year. So we'll try to pop some of those balloons, while also giving you very concrete information. If we look at the gold price reached a record level last year on an annual average basis. On a daily basis, it set several new records over the course of the year. The gold price started last year around $2,200, $2,100. It broke above that late March, early April, and it moved into a higher range, closer to $2,300 to $2,500. And then it continued to move higher into a peak at the end of October. Once we got into November, the price came off and it consolidated over the course of November and December, but it consolidated above 2,600 for the most part. So we saw gold prices continually rise. They rose further into the beginning of this year, and we've reached new record levels over $3,000 an ounce. CPM Group's expectation is that we will continue to see strong gold prices possibly into April. We think that the price will plateau and perhaps come off a little bit over the course of the second and third quarters as the political and economic environment maybe doesn't improve. It could actually deteriorate, but we might see that markets become a little bit more normalized in their reactions to what's going on politically and economically in the United States and around the world. We wouldn't be surprised. We're not here today with the Gold Yearbook to talk about where we project gold prices to go, but there are a preponderance of the 80 plus questions that we got. Where do you think the gold price is going this year? Where do you think it'll be at the end of the year? Where do you think it'll be in 10 years? That's not the purpose of the Gold Yearbook. The purpose of the Gold Yearbook, which is about 250 pages long, is to give its readers a lot of data and analysis to help them decide where they think the price of gold is going. Now, that said, we understand we have a great reputation in projecting the prices of gold, short-term and long-term, and that's what a lot of people are interested in. We wouldn't be surprised to see the price of gold back off in the second and third quarters and maybe go down to test $2,750, maybe even fall a little bit further. However, given the state of the world right now, we think that the gold price will stay high. It will move further up over the course of the last 4 months of the year, probably end the year higher than where we are today. And that we'll probably see another record annual average gold price this year and again next year. We don't see the economic and political issues that are causing investors around the world to buy increased amounts of gold dissipating after 2025. We see them continuing into 2026. So we're looking at a couple years of very strong gold prices. Perhaps not, well, actually, we have gold rising almost as much this next year as this year as we saw last year. This is a longer term price chart, and you can see, yes, the gold price has risen sharply. We are in one of these peaks where you've seen it several times. It doesn't really show up here in 1968, but we saw the price of gold go from about $35 to about $68. So doubling, coming back off. Then we saw the big rise in 1979 into 1980, came back off. Big rise from 2002 into 2011, came back off. And now we're into another one of those. And it's interesting and important to note that after these peaks, the price tends to subside but it has never subsided back to where it was prior to the run up. We saw $190 gold in 1978, and it went up to 850. When it came back down, it spent most of the next 20 years really trading between $300 and $360. A couple spikes up, and 5 years down below $300 from 1997 to 2002. So our expectation is that at some point the price will come back off, but we don't see it going back to 1600, except maybe on a spike down if the world got to be a much better place than we expect. We do have scenarios where it comes down, but our main 10-year projections have the gold price staying at record high levels for the next 10 years. We look at gold and silver a little bit inappropriately. This chart, which is difficult to see, is 9 different asset classes. And you have to understand, an asset class like, say, the S&P 500 is 500 individual investments, each of which is much more volatile than an index of 500. And you can see across this various asset classes and their annual performance from the start of the year through the end of the year. We add gold and silver in, and those are individual assets, so they're more volatile than indices. But you can see that gold was the top performer last year with a 27% increase in gold price, and silver was the third best performer at a 20% increase over the course of the year. You can also see that gold and silver are very volatile because we're comparing them to indices, which tend to be less volatile. But you can see that gold has been in the top 4 performance over the last 5 years, and silver has been in the top 3 performers over the last 5 years too. So they do very well when competing with alternative assets like stocks, bonds, real estate, cash, treasury bills. One of the things that we've heard recently over the last couple quarters is that COMEX is running out of gold and silver. In fact, COMEX gold reserves are at record levels. They're over 40 million ounces of reported reserves, both the reported inventories, both the registered and the eligible are extremely high. There's a tremendous amount of gold in COMEX depositories right now. There has been a large amount moved in, not only from London, but also from Hong Kong and Singapore and Switzerland and other major markets. We've seen a lot of gold move into the U.S. There are the COMEX registered depositories are not owned by COMEX, by the way. Some people seem to think that. They are major distributors and depositories and vaulting services in a capture area within the northeastern part of the United States. Not all depositories within that capture area have become registered COMEX depositories. There are some that do not do that. And there are major depositories around the rest of the country in Nevada, California, Florida, Idaho, and other parts of the world, country, that are not COMEX registered depositories. And we've seen an inflow of precious metals into those markets too. We've also seen an increase in all kinds of weird speculation as to why this metal has been moving in. The real reason and the main reason is that investment demand for gold and fabrication demand for gold have been higher and stronger in the United States and Canada, in North America, than they have been in the United Kingdom and Europe. So we've seen bullion trading companies and bullion banks, companies that supply gold to fabricators, saying, and investors, we need gold in the United States. And that's a major reason why we've seen this gold flow into COMEX registered inventories and reported inventories. There's a lot of other gold that hasn't gone into COMEX depositories. Rohit will give you details later. The Central Bank of Poland has, over the last couple of years, bought 6 million ounces of gold. It was the largest central bank buyer of gold in 2024. And of that gold, about 6 million ounces are estimated to have been added to the New York Federal Reserve Bank's gold depository. The New York Federal Reserve Bank will hold gold for foreign governments and, in recent decades, the U.S. government. And the Polish Central Bank has been buying gold really for the last 3 or 4 years. They bought 1 million ounces in the first 2 months of this year alone. They bought about 5 million ounces last year. And their view is we want our gold stored as far away from Russia as possible. So we've seen an increase of about 6 million ounces of gold into the New York Fed. That doesn't show up here because the New York Fed is not a COMEX registered depository. So you can see this large surge from, say, 16 million ounces, 17 million ounces of total reported inventories in the middle of 2024 to more than 40 million ounces. You can see, do the math, it's 24 million ounces of gold added to COMEX. But we also know there's another 6 million ounces that have been reportedly added to the New York Fed. And we know that there's a lot of other gold that has gone into other depositories. The main two reasons for this influx of gold into the United States has been stronger demand from investors and fabricators in North America than elsewhere, and the Polish Central Bank. On top of that, after the election, the incumbent Trump administration started talking about tariffs, tariffing this, tariffing that, tariffing anything that moves. Oh, and there was speculation that gold and silver coming from Canada and Mexico might have a 25% tariff. That caused bullion traders, bullion banks, and speculators to say, well, if there's going to be a 25% tariff on gold imported into the United States, and most of the demand that we're seeing and the demand growth is in North America, let's move gold and silver into the United States sooner before any such tariffs are high. So you have that come along as a third factor late in the game. So most of this has been fundamentally driven. Fundamentals of stronger investment demand and stronger. Now, as that gold has moved, you heard stories about London running out of gold or running out of unallocated gold and the gold all being drained from the Bank of England. These are reported inventories in the London market. The London market members, there are 11 clearing members, market makers that are members of the London Bullion Market Association, the trade association. They started reporting inventories of gold and silver in 2016, July of 2016. And before that, it was all speculative as to how much it was. The blue part is the gold that's held at the Bank of England. Bank of England, along with the New York Fed, is a place where central banks hold a lot of gold. And it has the distinction from the New York Fed in that the New York Fed will only hold gold for governments and central banks. The Bank of England will allow bullion banks and other major corporate entities to hold gold there as well. But you can see, yes, we have seen a decline in the gold held at the Bank of England. And it's a minuscule amount of gold compared to where they are. They had, when they started reporting gold, more than 150 million ounces of gold in the Bank of England, and they have even more gold than they had in 2016. So they're not running out of gold. And the red part is gold held within the LBMA network that is not held at the Bank of England. And you can see that, again, that also has increased over the 9 years since they started reporting inventories. It has come down. It actually rose sharply during the pandemic into 2021. And the bulk of the decline in metal there was in 2022 and 2022, not in 23 and 24. There had been some further decline. And again, as with North America and the United States, there are other depositories in the United Kingdom that are outside the capture area of the LBMA, are not registered with the LBMA as qualified depositories. And there are massive depositories in Switzerland. Our estimate is that Swiss gold holdings have risen more than 150 million ounces over the last 20 years, added to already large Swiss inventories prior to that. And then there's depositories, obviously, around the world. So the world's not running out of refined gold. London is not running out of refined gold. New York is not running out of refined gold. And if London did, in fact, have tight supplies, the London price would be rising more sharply than prices elsewhere, i.e. New York, right? New York's price has risen more sharply than the prices in London and elsewhere, partly because of the greater demand here. And that's why the gold has flowed in here. If London were running tight on supplies, its price would rise further than the price in New York. The arbitrage opportunity, the spread between London and New York prices, would reverse, and people would start shipping gold back into London. The fact that that has not happened is evidence that London is not running out of gold, allocated or unallocated. So, tempest in a teapot. Be careful when you start hearing people tell you that you should be buying gold because London's running out of gold or New York's running out of gold. Not happening. Another thing that's come up, I saw a very interesting quote this morning. It was from a professor of, I guess, mineral economics or something at a major university who said, by the way, there's no deposits of rare earths in Ukraine. It's an interesting fact because you can find people in positions of power who will talk about stuff that clearly is not actually true. One of the things is how much gold is in the U.S. government's gold holdings. It's 261 million ounces. Is the gold really there? Well, yes, it's there. And you found people, Trump and Musk among others, saying, well, we don't know. The gold's not there. It hasn't been audited. Well, yes, it has been audited. It's audited every year. And and the U.S. Treasury had an independent audit and assay done of it, like from 2000 to 2008. It took that long because there are like 60,000 or 600,000 bars. I mean, divide 261 million ounces by 400 and you get the number of bars. It took a long time to check every bar, to pick it up, look at it, inspect it, weigh it, check its serial number against the bar list that the Treasury has, take spot assays of representative bars, and have an independent assay lab do that. That's all been done, and it's been done within the last 20 years. So the gold's there. So then you get this pivot. Well, even if the gold is there, I know I've been saying I don't think the gold's there, but okay, let's say that I was lying, consciously misleading you, just making this stuff up. But even if the gold's there, we don't know if it has been hypothecated. In other words, okay, you caught me on that lie, let me try another one. It's all nonsense. Then they say, well, maybe the government, because it's doing all kinds of things in an amateurish way, would try to use that 261 million ounces to somehow or other solve the federal debt problem, We have a deficit that was $1.7 trillion a year. It's probably going to be about 2.7 in the next couple years per year because of some of the changes going on in the government. We have $36 trillion in debt. The 261 million ounces at $3,000, $2,900 is $800 billion. $800 billion, right? That represents 42% of last year's federal deficit. Let's say 5 months worth of deficits, right? It represents 2% of debt. You cannot solve a $36 trillion debt problem with 261 million ounces of gold. So then they say, well, okay, well, maybe the government will revalue its gold. And you get these outrages. Oh, maybe we'll revalue it at $10,000 or $40,000, and then the debt's solved. No, the debt's not solved. And that number is bogus. The gold price is determined minute by minute in an international market. The price is over $3,000 today because people around the world say, I think gold's worth $3,000 today. 2000, when the economic environment looked a lot better, they said, I think gold's worth $270 an ounce. As things got worse over the next 25 years, they said, no, I think it's worth $3,000. U.S. government says, I think our gold's worth $40,000. And everybody laughs at them, right? Then they say, well, maybe we'll sell some. So the price of gold doesn't go to $42,000. It goes down because if the world's largest holder of gold at 261 million ounces says, I have $36 trillion worth of debt, I'm going to sell some of my gold to help me with my deficit and debt problems. The world says, oh gosh, there's going to be a lot of gold coming into the market because even if they sold every ounce, which is representing about more than 2.5 years worth of annual supply, that's about 2 years of annual supply, they would be glutting the international gold market. So the idea that the Treasury could somehow or other use its gold to solve its deficit and debt issues is nonsensical. And yet, here we are having to talk about it when we should be talking about more important things. But I'm going to leave the more important things to Rohit. Very quickly, people talk about gold and oil. Here's the relationship. It's non-existent. Like, obviously, there is some connection. When oil prices rise, it hurts the economy, it hurts the stock market, and people say, oh, the economy and the stock market's hurting. I should be buying some gold, moving some of my wealth into gold. And when the oil price rises, countries and governments that have a proclivity to holding gold as part of their wealth have more money to put into gold. They're getting paid U.S. dollars. The U.S. economy is suffering from the higher oil prices, displacing consumption away from other goods and services. So you see increased demand for gold with increased oil prices. But the relationship, the correlation between the two is nonsensical. It's non-existent. It's not important. Right. Another thing you keep hearing is, oh, well, the gold price is rising because the dollar is falling. Well, here the dollar is on an inverse scale. So that green line going down actually is a rising dollar. And you can see that the dollar has been rising along with gold really since 2002, 2012. So you have a situation where the dollar actually is at the highest level that it's been since 2002. The gold price is the dollar is rising, and gold prices are rising. Gold prices are not rising because the dollar is falling. Gold prices are not rising because people are dumping the dollar. International holdings of U.S. Treasuries are at record levels. They rose 10.5% in 2023 to a record more greater than $8 trillion. And they rose another 7.5%, 7.4%, I think, in 2024 to close to $10 trillion. There may be some entities that are selling dollars or T-bills, but on a global basis, people are actually moving into T-bills and the dollar. And there's a reason for that. The T-bills have one of the best credit ratings in the world. Everything else, government bonds issued by other governments, corporate bonds, municipal bonds, have less sterling credit rating than treasuries. When you, as an investor, become afraid of the state of the world, you shift to treasuries and to the US dollar and to gold. And that's what's been happening really for the last decade. And that's probably what's going to happen over the next time. Now, people say, well, yes, but if you look, the People's Bank of China has reduced its dollar holdings. Yes, it has. The People's Bank of China has been taking money out of its reserves, most of which are stored in US dollars, and using it to try to shore up the economy because the economy is in severe economic problems. Tax receipts within China to the federal government actually declined last year, right? For the first time in a long, long time. The Chinese government needs money. The People's Bank of China has money. The money's in the dollars. The People's Bank of China is giving that money to the government to help shore up the economy. And they're really happy that that money is in US dollars because the dollar has been strengthening. And if they had that money in other currencies, they wouldn't have as much money to shore up the economy. So the dollar's not falling. Gold's not rising because the dollar's falling. Let's get a light. Now, that said, and this is my last slide before I kick it over to Rohit. That said, CPM Group has a relatively negative view for the economy over the next 2 years and over the next 10 years. These are our economic projections going out over the next several years. We have a recession in the industrialized world, 2025, 2026, that actually takes global GDP negative for a year over this period of time. We had thought that the recession could emerge as early as 2024. We actually saw relatively good economic conditions last year. But looking at the state of the world, our expectation continues to be that we will see a relatively severe recession over the next 24 months. And very importantly, when we come out of that recession and we go into the recovery and then a new expansion, the rate of growth on a global basis in the industrialized world as well as in the emerging markets will be lower than it has been for most of the time from the 1980s into the last few years. So we have a hostile economic environment. We also have a hostile political environment, both globally and among various countries. So our expectation is that investment demand will continue to be very strong because people will be looking to protect their wealth in a hostile economic and political environment. But I'm going to kick the presentation over to Rohit now and let him start talking about the fundamentals of the gold market last year and this year. And then I'll come back for the question and answer period. Thank you.
Thank you, Jeff. So I'm going to start here by talking about gold investment demand. Gold investment demand is by far the most important gold market fundamental when it comes to influencing gold prices. We saw gold investment demand rise pretty strongly last year. It rose to 36.6 million ounces, which was a 64.7% increase over 2023 levels. And despite this strong increase in gold investment demand last year, it was still lower than levels that we saw in 2020 or back in 2008 through 2012. And the key difference is that in those past years, the global economy was actually in a recession or was undergoing severely strained economic conditions, which was not the case last year. Last year, most of the gold buying or the increase in gold investment demand was done in anticipation or in over concerns about potential problems. This year, we expect gold investment demand to continue rising. We forecast that gold investment demand would reach 38.6 million ounces, which would be a roughly 5.5% increase over last year's gold investment demand. And we should say here that the risk to this projection is to the upside. So there's a higher probability that gold investment demand actually overshoots the 38.6 million ounces that we project here than undershoots it. So let's look over some of the factors that affected gold investment demand last year. As I mentioned, it was mostly concerns about sustainability, the sustainability of the relatively good economic conditions that you had in certain parts of the world, the high equity values that you were seeing, and how long this could last, had investors nervous, which resulted in some diversification away into alternative assets like gold. And that's really what contributed to a large extent to that increase in gold investment demand last year. You had inflation softening, but the rate of decline was slowing. And there were concerns about whether inflation would in fact reach various central bank targets in the coming years. And then political tensions have been an important factor supporting and pushing gold prices higher over the past many years. So last year you had two ongoing wars. You also had elevated strained relations between the West and Russia and China. So all of this had investors nervous about what the consequences of these strains in political relations could mean for economic growth and if they could precipitate a recession. In terms of what hurt gold investment demand last year was the high price and the rapid increase that we saw in gold prices. There are certain portions of or certain parts of the gold investment market which are more sensitive to prices than others. In particular, if you look at demand for gold coins, coin investors typically tend to be very sensitive to high prices. And we did see a pullback in demand from these investors. This year, you are seeing a renewed concern about rising inflation. And that concern is tied to this imposition of trade tariffs by the US on its various trading partners and the reciprocal tariffs from those trading partners on the US and what that would mean for inflation globally. Last year, without these tariffs, inflation was already struggling to come down. Now, with these tariffs, there's an increased concern that you might see inflation actually rising over the next few years. There's also an increased concern now about a recession. This concern had gone dormant last year, with the main thinking being that we'd have a soft landing, but now that's changed to a resurgence in that concern about a recession. Part of it is tied to expectations of rising inflation, which would reduce consumption of discretionary products. It would result in relatively higher interest rates. You also have a lot of uncertainty about tariffs, and that's resulting in businesses putting investment on hold. If that continues for an extended period of time, that could result in causing a recession. You also have private spending being diverted from investment in manufacturing or productivity towards paying for government tariffs. So that's again something that we think might act as a drag on economic growth. And then you have mass firings of federal workers, you have mass deportations, again, factors we think that would hurt consumption, which is a major driver of economic growth, especially in the US. In addition to this, you have projections of growing federal deficits. The CBO is projecting $1 trillion in increased deficits per year over the next 4 years, which would then result in an increase in federal debt to pay for those deficits. And an increase in federal debt is going to result in keeping interest rates at relatively higher levels. It's also going to result in diverting funds again from private investments towards paying for government debt, which again would be another reason why economic growth could slow down. We think that higher interest rates, or relatively higher interest rates, is something that would be supportive of gold investment demand. This is counterintuitive to what is believed in the markets, which is that higher rates would typically mean weaker gold prices. But why we have higher rates matters more than what is happening with rates. So if interest rates were rising or remained elevated because of strong economic growth, that would in fact be negative for gold. But if you have higher interest rates because of concerns about inflation or because there's growing federal debt, then that is actually positive for gold. Another thing with high rates is that markets tend to be a lot more sensitive to political risks or economic risk in a relatively higher interest rate environment than what they would be if interest rates were weaker. And then you have the ongoing political tension. So all of the problems that we saw last year, they still exist. And now you have questions about the NATO alliance and what that means for the geopolitical landscape and how things would play out because of the tensions that are rising in that area. So a lot of factors that we think would be supportive of gold investment demand this year as well. And again, in terms of what we think would hurt gold investment demand is the high price of gold. Again, in hurting the more price-sensitive parts of the market, like the coin buyers. So what this chart is showing us is the 2-year break-even inflation rate, which is essentially a market-based expectation of what inflation would look like over the next 2 years. And as we can see in the chart, since the fourth quarter of last year, it has been rising, and it's continued to rise through the first quarter of this year. Much of this increase is tied to the coming to know that there's going to be, potentially a trade war, which could boost inflation. So as of last week, this rate has now risen to the highest level that it's been at since March 2023. And depending on how things play out over the rest of this year in terms of tariffs, this rate could continue to rise. So this table shows you the different factors that we think influence gold investment demand. The extent to which these factors are positive or turn positive is what we think influences the strength in gold investment demand and consequently the price of gold. So as you can see, most of these factors have been positive over the past few years, which has been reflected in healthy gold investment demand as well as strong prices. The one factor that has been a bit of a headwind is the supply and fabrication demand fundamentals, where because of the higher price of gold, you have been seeing an inching higher in scrap supply and a weakening in fabrication demand. So this one factor has been a little bit of a weakness or a bit of a headwind, but it is overpowered by all of the other factors that have been strongly positive over the past few years and expected to remain positive this year as well. This chart shows you the net gold buying and selling by ETFs and the gross holdings of gold in ETF products. So after 3 consecutive years of net reductions, last year you saw a marginal increase in gold ETF holdings. Gold ETF holdings rose by about 465,000 ounces last year. which barely made a dent in the reductions that we had seen in the previous 3 years. And most of that increase can be attributed, in fact, all of that increase can be attributed to increases in Chinese and Indian gold ETFs, which help to offset weakness in ETF holdings in Western markets. In the first 2 years of, in the first 2 months of this year, we have seen gold ETF holdings rise. They've been up about a little over 3 million ounces. And this year, so far, the growth and increase has been more broad-based in that you are seeing an increase in gold ETF holdings, both in Western markets as well as in Asian markets. And we do think that gold ETF holdings could show some further growth as the year progresses. This is a gold coin demand. And as I mentioned before, it has been weakening. It has been weakening over the past couple of years in response to strong prices. Last year's rapid growth in price played a fairly important role in weighing on gold coin demand. It's fallen from its recent highs. A more stable gold environment, even if prices are high, could see coin demand rise. But if you see the kind of rapid increase that you saw last year, that's probably going to create another year of weakness in gold coin demand this year. So with that, we move on to gold demand from central banks. Central banks were net buyers of 8.2 million ounces of gold last year. This, combined with net purchases by investors, played an important role in both supporting gold prices as well as helping them to rise. Now, while net purchases were positive during 2024, they were down pretty sharply from 2023 levels when central banks added about 13.9 million ounces of gold to their holdings. The primary reason for the weakness in central bank net purchases last year was the strength in gold prices. Not so much the high level of gold prices, but the pace at which gold prices rose. We have seen that central banks have been net buyers of gold even in a high price environment. So if you look at the period between 2021 and 2023, when gold prices were elevated, you still had central banks buying on average about 11 million ounces of gold per year. But the sharp increase that we saw in gold prices last year did result in some central banks pulling back on making fresh purchases. Heading into 2025, we expect gold prices to remain elevated, but we don't expect them to rise at the same pace that they did last year, which should help to benefit net purchases by central banks. Based on this, we think that central banks would be net buyers of around 10 million ounces of gold. The one factor that we think would be a headwind to central bank gold buying this year would be that central banks don't necessarily think about their gold in terms of ounces, but more in terms of the value of the gold in relation to the rest of their reserve assets. And so the high price of gold that we are expecting would automatically boost that value and would reduce the urgency among some central banks to be adding gold to their holdings. That said, there are a lot of central banks who are in the process of aggressively adding gold to their holdings for a variety of political reasons. And we think that that would continue and would remain supportive of net buying by central banks during 2025. So what this chart shows us is the inverse relation between gold prices and net purchases by central banks. And as you can see, there is a fairly obvious inverse relation. In years when gold prices have come off, you have seen central banks increase their purchases. And then in other years, when gold prices have risen, you have seen a pullback in central bank buying. That said, again, it's mostly in years when you see sharp increases in gold prices. That's when you see central banks tending to pull back on their purchases. So if you look back at 2020, you saw a sharp increase in gold prices and a consequent decline in central bank buying. You saw a similar situation last year where there was a sharp increase in prices and a pullback in buying. But if you look at the period between 2021 and 2023, gold prices were historically elevated, and that did not necessarily slow demand from these central banks. So the correlation has been softening compared to where it used to be historically. So if you look at the inverse correlation between these two factors, between 2008 and 2018, it stood at negative 0.67. When you take this correlation out through 2023, it actually dropped to negative 0.61. And if you include 24, it went up to 0.63. But even at 0.63, it's still lower than what it used to be between 2008 and 2018. And that's really central banks. That's that reduced sensitivity that you see among central banks to the higher price of gold. And we expect that to continue going forward. So one of the main reasons why central banks have been buying gold is to diversify their reserve assets, and that's beginning to pay off. Last year, you saw gold as a percentage of total central bank reserves reaching around 17%, which was the highest level that it's been at since the mid-90s. Part of this has to do with the net buying that you've seen over the past 16 or so years. But a major part of it really has to do with the sharp increase that we've seen in gold prices. And it's important because you're seeing this increase despite a pretty substantial increase in the amount of forex that is accumulated by these central banks. So last year, forex holdings among central banks was at the third highest level that it's ever been. And gold still accounted for around 17% of total reserve assets, which when you look back at the mid-90s, the amount of forex held by central banks was significantly lower than what it is been in recent years. So the diversification efforts that the central banks have been trying to make is beginning to show up now in the numbers. You're also seeing an increase in the diversity of the forex that is being held by central banks. So it's clear from this chart that the US dollar accounts for the vast majority of central bank forex reserves. But that said, the reserve holdings have been declining in recent years. And in the third quarter of last year, the US dollar only accounted for about 57% of central bank forex reserves, which was the lowest it's been at least since 1995. You're seeing a similar situation in the case of the euro, where euro's percentage of central bank reserve assets peaked in 2009 when it stood at about 28%, and it slipped down to about 20% since then. So there are a few things that have happened over the past several years which have reduced the amount of US dollars and euros that are being held by central banks. One is you had the sovereign debt crisis, which shook the confidence in markets about the euro. You've had an increase in deficits and debts in the US, and they keep growing, which is again making markets somewhat nervous about the US dollar. And you also have increased tensions between the West and countries like China and Russia, which have also contributed to a slight decline in the amount of euros and dollars held by central banks in their forex reserves. Going forward, we do think that the dollar and the euro will continue to dominate the percentage of forex reserves, but there is a chance that the percentages will continue to decline at a slow pace going forward. There is no currency right now, and there's unlikely to be any currency in the foreseeable future which is going to have the same level of liquidity or depth that the US dollar market has. So that will keep the US dollar the dominant forex holding for central banks. But you are seeing, for example, in the case of China, last year was the first year when China was able to settle more of its trade in renminbi than it did in the US dollar. And that's a first step towards increasing the amount of renminbi held in forex reserves versus other currencies like the dollar and the euro. So with that, we move on to supply. Total supply rose last year. It rose by about 0.6% to 130 million ounces. That increase was entirely driven by scrap supply, with mine production actually declining last year. Scrap supply rose because of stronger prices, but the increase in scrap supply was not very strong. And that's because in addition to prices, there are other factors that also influence scrap supply. So one of those factors is what economic conditions look like. And while there were pockets of weakness in the global economy last year, for example, there was some weakness in certain European countries and there was weakness in Chinese economic growth, which did help to support gold scrap supply from these regions. It was not a strong enough factor to drive scrap supply higher. Also, you had a belief around the world that gold prices will remain elevated and likely to continue rising in the next few years. So in the absence of any immediate reason to scrap their gold holdings, there was a reluctance on the part of people to scrap their gold in anticipation of these stronger prices in the future. This year, total gold supply is forecast to rise again. The growth is expected to be stronger, rising about 2% over what it was last year and reaching a fresh record high of 133 million ounces. Both mine production as well as scrap supply are projected to increase this year. Mine production is expected to rise primarily because of some new mines that have come on stream in recent years, which are expected to be ramped up during 2025. That said, the net increase that we are projecting is small at around 750,000 ounces, which if there is a suspension at any major mine or at multiple smaller mines due to political reasons, environmental reasons, or technical reasons, any sort of suspensions could eat into this 750,000 ounce increase or even reverse the net gains that we are projecting for 2025. Scrap supply is expected to rise more strongly during 2025, in part because of even stronger gold prices than we've seen in 2024, but also because there is an expectation that economic growth will slow more broadly, and there is a potential for recession in the second half of this year. And that could be something that could draw out more of the scrap supply. So because of this, we anticipate total supply to rise during 2025. This data has been pulled from S&P Global Intelligence, and this shows the amount of spending done, exploration spending done in the gold mining sector, and it declined for the second year last year. That said, it was still higher than the levels of spending that we saw between 2014 and 2020. The reason for the decline last year was that interest rates were relatively higher and funds were being diverted towards energy transition metals. CPM thinks that allocations to gold would increase in 2025, in part because of the strength in gold prices. The fact that the strength in gold prices have been sustainable over the past many years now. And the fundamentals for these energy transition metals is looking a lot more dubious now. It's not looking very strong. So that might result in some of those funds being rediverted towards the gold sector. So you could see an increase in spending during 2025 in the gold sector. New gold mine capacity has been rising over the last 3 years, and it rose to its highest level since 2019 last year. A few large mines came on stream, which as they ramp up are the mines that we think will help support mine supply in 2025. New mine capacity is expected to soften during the current year relative to 2024, but is expected to be in line with levels that we've been seeing since 2020 through 2023. Gold mining all-in sustaining costs rose to new record high levels last year. This was not entirely surprising. You've been seeing there is a positive correlation between costs and the price of the underlying metal. One of the main reasons for that is because when metal prices rise, you do tend to see mining companies divert their attention towards lower grade ore, which then tends to push up costs. You also see an increase in inputs for mining, whether it be labor or other inputs. And then you've also seen a general uptick in inflation around the world, which has been another contributing factor to mining costs. So all of these factors collectively have helped to boost the all-in sustaining cost of gold, which reached fresh record highs last year and are likely to boost costs for the coming year as well. And with that, we finally move on to fabrication demand. Total fabrication demand declined pretty sharply last year. It slid to about 85.5 million ounces, which was an 8.5% decline from 2023 levels. This was the lowest level of gold fabrication demand since 2012, if you exclude 2020. The main culprit here was the high price of gold and the rapid increase that we saw in gold prices. Jewelry demand accounts for about 85% of gold fabrication demand. And this source of demand is particularly price sensitive because jewelry demand is discretionary. And so consumers tend to put it aside if the price of gold is rising the way it did last year. You also have fabricators of gold jewelry not typically hedging their purchases. And so when you see gold prices rise the way they did last year, quite often they need to pass on those costs to the consumer, which then further depresses gold fabrication demand from the jewelry sector. You also had some country and region-specific issues. So weaker economic growth in China, softer economic growth in European countries weighed on gold jewelry demand, again, because it's a discretionary purchase. In times when economic growth is not particularly strong, consumers are not going to be diverting their funds towards buying gold jewelry. Similarly, in the case of the US and Japan, you had a separate problem, which was inflation levels were high, which again reduced the amount of funds available for discretionary purchases. So the discretionary nature of gold jewelry demand weighed heavily on gold jewelry last year, and the high price of gold didn't make it easier to help gold jewelry demand rise in 2024. Chinese gold jewelry demand did weaken last year, in part because of the weak economic growth that the country was experiencing, as well as the high gold price. This year, we think that Chinese gold jewelry demand would stabilize at its lower level. In the case of India as well, which is another major consumer of gold jewelry, the high price of gold had a negative impact on gold jewelry demand, but you did have a couple of factors that softened the blow. So one, the economic conditions in India were pretty strong last year, and you also saw a sharp decline in import duties from around 15% to 6%, which resulted in a flood of gold into the country during the second half of the year. This increase in imports lowered domestic prices and helped to provide some support to gold jewelry demand during 2024 in India. In 2025, gold jewelry demand in India is expected to be negatively affected by the high price. Economic conditions are expected to be weaker this year than they were in 2024. The only factor that seems to be supportive of gold jewelry demand in India in 2025 would be a nearly 57% increase in the number of auspicious days for marriages in the country this year. So that could help to provide some support to gold jewelry demand in the current year. So with that, I'll pass this back to Jeff for some closing remarks, and then we will open it up for questions.
Yeah, thank you. Thank you, Rohit. So that's our CPM Group 2025 Gold Yearbook. You can buy the book at our website. It's $160 US. It's an ebook, so you can take delivery right away. We expect to have it up either this afternoon or tomorrow at the latest. In the middle of May, we will come out with our Silver Yearbook, and in late July, we'll come out with our Platinum Group Metals Yearbook. We do have what we call the Retail Investor Program, which is a economic program that provides the yearbooks as well as ongoing research and our ultra short-term trade recommendations to investors who are interested in more trading orientation. And you can go to our website and order all of those books, pre-order the yearbooks, subscribe to our Precious Metals Advisory. There's a lot of free reads and videos there to give you a good flavor of who we are and what we do. It is research-driven, research and consulting services. We are not a marketing group. We do not, we do sell our research to companies that market precious metals and precious metals mining shares, and they do use our research in their stuff. But what we sell is intelligence and knowledge, research and consulting services. And you can contact us at info@cpmgroup.com. I'll ask Carlos to join us now. He'll manage the questions. We've gotten a few questions written in. Again, there is a thing on your dashboard that allows you to write questions. To us, and then we have 80 some odd questions. I'll address at least one thing that I had said earlier. There are more than 650,000 gold bars in the U.S. Treasury's gold reserves. More than 650,000. And as I said, in the deep audit, bar by bar audit, where they inspected each bar and weighed each bar and measured it and checked it off against the bar list that they had. It took a long time to get through that inventory. Carlos, do you...
Yes, Jeff.
Go ahead.
Yeah, so we have a few questions. And Jeff, you have those 80 questions as well that were sent in prior. You answered many of those during the presentation. But here are some of the questions that we received just now during this presentation. So the first one is, what impact do stock market crashes have on gold and gold mining stocks?
Yeah. It's interesting. Well, let's talk about gold first, and gold stocks are somewhat separate. Oftentimes when you see a stock market, and crash is a weird term, like a sharp decline in overall stock prices. It could be a crash, or it just could be a major decline of 10% or 20% or even more. In 2001, I think the NASDAQ came off about 80+%, while the New York Stock Exchange was off 40 some odd percent. New York Stock Exchange had market makers at the time, and NASDAQ didn't. Oftentimes when you see that kind of decline in stocks, you'll see people liquidating their gold to drive into cash, partly to cover margin requirements that they have in their overall portfolio, including stocks and bond investments. What you will see oftentimes, and this was the case, for example, in 2009 going forward, is that the gold price will tend to recover much more rapidly than the equity markets because the gold price will have fallen because people are driving the cash in that emergency. Once that emergency is over, they'll replenish their gold positions while the stock market takes longer to recover. We don't cover publicly gold mining companies. We do research on them because it's important for our research program. But gold mining shares tend to perform like shares in a stock market. So they tend to come off along with the stock market, and they tend to recover more slowly. One of the things.
Okay. Related to that is, do you expect gold miners to increase in value this year relative to the price of gold?
Not really. We've talked about this for a few years. We've done a lot of research, and what you find, what our analysis it tells us, is that investors in general are moving away from individual stocks, not just mining stocks, but individual stocks, and there is a shift toward indexed investing and ETF investing. And the problem is that for mining industry, a lot of the mining companies have low market capitalization, and they don't make it into those ETFs, and they don't make it into those indices. So we see a issue that has something to do with mining and mining companies' financial performances, but a much bigger impediment or headwind to stocks, mining stocks rising, seems to be this much broader shift away from investing in individual companies on the part of investors. So it's a stock market issue as opposed to a mining issue.
Okay. Another question. Do you anticipate any major impact on the gold price if and when Russia's reserve assets, frozen by the EU, are finally released?
Well, that's a tough question, because first you have to say a couple things. And first is, if and when those reserves are released. And when they are released, to whom will they be released? There are moves within Europe and the United States and other countries that those reserves should be given to Ukraine to help finance reconstruction, given the scorched earth war effort of Russia. So first, and another thing to understand is those reserves are not gold. Russia keeps its gold reserves in Russia, and those reserves that are frozen are primarily foreign currency reserves. So you have that first set of the issues, like, well, what are the reserves, and will they be unfrozen? And when they are unfrozen, to whom will they be given? It's not clear that they'll go back to Russia. I think that Russia doesn't expect to see much of it coming back. There is a substantial portion of their foreign exchange reserves that are held in China and other countries. That stuff probably will come back to them. But the stuff that's held elsewhere may not come to them. There is, there's a broader issue, which is what happens to Russia's gold reserves going forward. And that depends on the outcome of the war and the resolution of the war. And there are a lot of questions about that right now. So it's there. But you have to understand that within Russia, there is growing opposition to the war effort. And it is, depending on how things shake out, it could be that Russia needs to sell more gold. We did see some pretty significant sales in January of this year by Russia, and I believe in December too. So it's hard to say, but if Russia has worsening economic conditions, it may wind up selling more gold out of its reserves than it has. It has about 75 million ounces of gold right now.
Okay. Many countries use gold jewelry as an investment, but this does not seem to happen as much in developed countries. Can you talk about the factors to consider for gold jewelry as an investment?
Yeah, it's one of the theoretic issues that we deal with at CPM Group is we have this thing, and Rohit showed it. It's true in gold. It's true in silver as well. You have this enormous, portion of fabrication demand that is jewelry, and it's jewelry developing countries. The red part is jewelry in developed countries. You've seen a shift in manufacturing away from the United States, Italy, and other developed countries. 20 years ago, you saw 20, 30 years ago, you saw this shift starting in the 90s, I guess, already. And the jewelry that's manufactured in developing countries consists of several different markets. And we see this in silver as well. And so there is the gold jewelry that is bought as a form of savings or an investment within developing countries. There's the gold jewelry that is bought as jewelry within those developing countries. And then there's the gold jewelry that's being manufactured for export to developing countries, where it tends to be a luxury item or adornment. So it's a whole range of things. But what you see in many countries, if you look at European countries, if you look at North American countries, Australia, a lot of the gold jewelry that is bought and a lot of the gold that's used in the jewelry that's bought is either 14 karat or lower caratage, or 14 karat or 20 karat plated or 18 karat gold plated jewelry. So jewelry is really an adornment in these developed countries. And one of the things, and Rohit may want to talk about this a little bit more, one of the things that we've seen in China and in India and in other markets is a move away from considering jewelry as a form of investment and seeing it more as a form of adornment, and investments being other things. And you've seen this in developing countries around the world. So it's not so much the idea that in developed countries, people might start to see their gold jewelry as a form of gold investment, because in those countries, the gold content usually is not as high a percentage of the cost of that jewelry or the value or the price of that jewelry as it is in other countries. What we're seeing is actually a shift away from gold investment, investing in jewelry as a form of gold investment in developing countries. So it's sort of going the other way around. Rohit, do you have things you want to add to that?
So I think what you see in developing countries is a difference between the demand in rural parts of the country and in urban parts. In urban parts of the country, you don't typically tend to buy gold jewelry which is, more than 18 carats or 24 carats. But in rural parts of the country, you do see that. And that is also now beginning to change. I think a lot of it had to do with a lack of solid banking systems or insurances. But all of that has now begun to change over the past several years, and there are other options for people who live in the rural parts of these countries to access finance. So I think buying gold jewelry as an investment, as you said, it's beginning to change, and it has changed a lot with a increase in demand for lower carat jewelry, which is not really viewed as an investment, but more as just owning gold jewelry.
Okay. Another question here is some gold promoters suggest that Trump's isolationism could weaken the dollar's role faster, and that could provide a boost to gold prices. What are your thoughts?
It's a very complex issue, and on the one hand, yes, but in the long run, yes, the dollar, in the long run, these kinds of unproductive and destructive of economic value policies will have a negative effect on the dollar. But because of the dollar's pivotal role as a de facto reserve currency, that day may be postponed. So, clearly there is a negative consequence. How long it takes for that to emerge really remains to be seen.
Okay, here's an interesting question. How should a fabricator who is outside the U.S. and imports gold into its country assess the combined effect of investment demand and the effect of exchange rates?
Yeah, the exchange rates are obviously very important. And if you're a fabricator, depending on what kind of jewelry you're manufacturing, your gold content might be extremely high. So in terms of the percentage of the value of the product, I have jewelry that I bought in Middle Eastern souks that for my wife that was 24 karat gold, and the markup was relatively low. So that puts you in a real bind. And obviously the downward pressure on a lot of currency rates relative to the dollar over the last couple of years have made it extremely difficult for consumers to buy gold jewelry and for fabricators to make gold jewelry. Some of the fabricators we know will lease in their gold so that they can have some price protection in their own domestic currency. But as Rohit said, many of them are smaller and they don't do any leasing and they don't do any hedging. So that puts it very difficult. But I think the key to understand is the investment demand, because as long as investment demand is high and is demanding a large portion of newly refined gold coming into the market, that's going to keep the gold price high, and that's going to reduce intuitively the assessment, it's going to reduce the demand for high quality gold jewelry. And that's going to be a problem probably for several years at least.
Okay. Given the investment demand and the speculation involved in the gold market, what is the potential for gold prices to rise toward $4,000? And related to that, what are our gold price estimates for the remainder of this year going into 2026?
Yeah. Gold can spike to $4,000. And, when we publish our long-term projections for gold supply, demand, and price, we we'll publish 3 scenarios, but we run a whole lot of other scenarios. And given the state of the world right now, it is quite possible that you could see $4,000 gold on a spike. The price probably wouldn't stay there. It would probably come back off relatively quickly. And our view is that the gold price toward the end of the year will probably be relatively close to where it is today. We will be updating our precious metals market advisory next week. Well, in the next 2 weeks. And we'll probably be increasing our projections for late 2025 and 2026. We have quarterly gold price projections in the precious metals advisory, simply because the price is much higher than it was a year ago. If you look at the gold price in the first 2 months of this year, it averaged $2,800, which was 39% higher than in the first 2 months of 2024. Our expectation is that the price will stay high. As I said earlier, we wouldn't be surprised to see the price come off as much as $2,750 in the middle part of this year. By the end of this year, tell me what's going to be happening in the Ukraine, the Middle East, the United States, the South China Sea, the Straits of Taiwan, and a number of other places. And then I can tell you what, in that kind of scenario, we might see gold prices. But we don't see the gold price declining sharply toward the end of this year. We see the price possibly plateauing over the next 2 quarters and then rising toward the end of the year.
And the last question is, when can this presentation recording be made available to the participants?
I'm sorry, what's that?
When can this recording presentation be made available to participants, to the attendees?
We're going to try to process this and post it yet later today. And it may be tomorrow at the latest that you would see this posted, this presentation online. Yeah. Okay.
No more questions from the attendees? Jeff, I don't know if you have any more.
Well, we have all the questions that were sent in earlier that you haven't addressed any of. Hold on a second. I'm having no problem. One of the questions that came in that was, I think, worth addressing, I did address it a little bit at the beginning, was a higher gold price could be interpreted as a weaker dollar. To what extent this weaker dollar can compensate for announced increases in tariffs and preserve U.S. competitive worldwide? Well, the answer is the higher gold price is not being accompanied with a weaker dollar. The dollar has come off a little bit in the last couple months, but it is still very strong. So it's not at all clear that the weaker dollar would, it's not clear that a weaker dollar would have any offsetting benefit to offset the negative effects on the U.S. economy of tariffs. It would possibly help U.S. competitiveness worldwide to some extent, but a weaker dollar would actually worsen probably U.S. overall economic conditions. So one of the questions, well, there were a couple questions about gold ETFs. One was, pointing out that there are any number of promoters or whatever you call them on the internet who say that the ETFs don't really have the physical gold. And that doesn't actually seem accurate to us. There are ETFs that do not buy physical gold, And they usually say that in their advertising and prospectus. But there are several dozen gold ETFs that do buy gold and in most cases hold it on an allocated basis. And that gold is there. So the idea that, first off, it's not really a valid issue to worry that the gold's not really there. There are other issues like the fact that for the most part, you cannot redeem your ETF shares in physical gold. You have to have two transactions where you sell your ETF shares, and then there's another transaction which you might have to take to a different brokerage house because some brokerage houses don't sell physical gold. So you might have to take your proceeds from your ETF sale and go someplace else to buy the physical metal. That's a bigger, more important issue to pay attention to with ETFs. And then there were questions like, would there be enough physical gold available if the investors wanted their ETFs if they wanted to turn in their ETFs for physical gold? Again, that's not an issue because, it's not an issue per se because most of those ETFs are not convertible or deliverable to gold. There are some that are, but most are not. So it's a big transaction. Second thing is that gold is available. So if there were a massive amount of ETF redemptions, there would be gold coming back into the gold bullion market, which would be available for investors to buy from bullion dealers. So that's probably not particularly a concern. Do you think that the U.S. will issue gold-backed long-dated treasury bonds as outlined by Judy Shelton? No, we don't. The reality is that Judy Shelton has been in favor of a return to a gold standard her entire career, as long as I've known of her, which dates back, I think, to the 1980s at least. I ran through some numbers earlier about the fact that the dollar value of the U.S. gold is minuscule compared to the U.S. government spending, deficit spending, and debt. So that the idea of using gold-backed long-dated treasury bonds, it would be a gimmick. We saw this as a proposal in the 1980 campaign by Ronald Reagan, where Arthur Laffer came up with a proposal that U.S. Treasury notes would be backed by gold at a 40% backing rate, knowing full well that since 1971, the Treasury hasn't really been issuing notes. They're Federal Reserve notes that are issued nowadays. And his whole thing was this very jaundiced view of the ignorance of the American voters, in which he said, we can tell people that Treasury notes will be backed by gold, and then we can issue Federal Reserve notes until the cows come home. It won't matter. So that's there. That's there. There's another question that's come in related to the President Trump's recent announcement on mining more gold in the States. Do you think that this will lead to gold prices going down? No. He says a lot of things that just don't happen. And the idea of a presidential decree or directive to mine more gold in the United States probably will have an immeasurably small effect on development of gold mines in the United States. I am interested in seeing what happens with the Trump administration's handling of some of the blockages that we've seen. The one that comes to mind is Northern Miner, the Pebble Mine in Alaska. And, fair disclosure, I actually own shares in that mining company. That is a very interesting situation where, from my understanding, the mine has been blocked for unreasonable reasons. And you see that not only in mining, but you see that across many specters of the U.S. society and economy and industry going on. We'll see what happens there, but I don't expect any large increase in gold mining in the United States as a result of the presidential decree. Yes. We do sell gold yearbooks to libraries. We also supply them. We give the Gold Yearbook to the Library of Congress, to the New York Public Library, and to the library at Baruch University. So they're ostensibly there to be checked out. And from time to time, we will see libraries elsewhere buying the books. And, the question, one of the other questions that I had there was the issue of a war premium that might dissipate if the United States and Russia makes a comprehensive deal to have a credible peace in the Ukraine. First off, it's not just the U.S. and Russia. The Ukraine obviously has a say, and believe it or not, Europe probably has a say there too. I'm not sure how it'll shake out. Right now, the Trump administration seems to be taking its cues from the Russian government, or at least from Vladimir Putin. We saw Mr. Witkoff saying two things. Like on Sunday, he said that he was duped by Hamas, which is pretty hard to imagine. And then he also was espousing Putin's view that the population of eastern Ukraine sees itself as Russian and had voted in referenda to be annexed into Russia. And he failed to point out that those referenda were actually held at gunpoint by Soviet or Russian troops. But it's hard to say how it's going to shake out. If a total capitulation to Russia occurs, which is what the Trump administration has been talking about, that would help restore some of the international stature of Russia and Vladimir Putin. And that could be very positive for gold. If a more equitable peace were to occur, and you might see the gold price come off. I'm not sure how much of a war premium there is right now, but you would have to look into what would be happening in terms of political change and leadership changes within Russia, which would be expected if a non-capitulative resolution were occurring. So, and then there's the definition of credible peace. As Mr. Zelensky pointed out, they had an agreement in 2014, which was completely ignored by the Russian government. So what kind of peace agreement are you going to get this time? And how credible will it be? And will it be credible to people in Ukraine and Poland and the rest of Europe? So it's hard to say. If tariffs are not applicable for silver as of April 2nd, as I think the current threat is, how would this affect its price? I think that the price of silver might come off if that were the case, because to some extent, part of the increase in silver prices over the last 3 months has reflected speculation that there would be a 20% or 25% tariff on Mexican silver imports into the United States. And so part of the move above 30 toward $35 probably would dissipate, and you could see the price come off a little bit. One of the things that was mentioned was that we haven't mentioned the Middle East conflict yet, but we mentioned the Ukraine-Russia war. And we have discussed the Middle East conflict in some of our YouTube videos, as well as in some of our reports, like the Precious Metals Advisory and special reports that we do. It's very interesting to see. And one of the things that you may have noticed in the last 17 months now is that Arab oil exporting nations have not used their oil production and sales and shipments as a political weapon the way they did in 1973 and again in 1979. And that reflects the fact that there are political tensions between many Arab states and Iran. And frankly, some of those Arab states wouldn't mind if Israel and the United States took a more militaristic approach toward their relations with Iran. So it's a very complex area to pay attention to. Right now, you're sort of at a stasis. You have people within the military and in the foreign policy sectors of the U.S. and Israeli governments who are arguing that there should be a strike to destroy Iranian nuclear facilities. That argument has been going on at least since 2006, 2005. And it will continue. There are other people who are saying, no, we really shouldn't do that. It's hard to say how that's going to shake out, what the balance of power within the U.S. government and within the Israeli government is going to be. But the Middle Eastern situation has the opportunity to become much more important to global economic and political developments, but it also has the capacity to remain in the same position that it's been in for 40 years, really. Going to wrap up pretty soon. I think I'll take one more question. Is a bimetallic gold and silver backed currency system likely in the near future or in the longer term? And the answer is probably not. It's probably not likely to occur for a variety of reasons. The monetary use of silver was demonetized. It's a financial asset, but it has been demonetized by, I guess, every government. And the idea of it coming back as a monetary metal is highly unlikely, given the small and illiquid and nature of the silver market and silver supplies and the volatile nature of silver prices. So a gold-silver currency system doesn't seem likely. And the gold system also probably seems unlikely too. Rowett showed a chart of monetary reserves at central banks, and you could see this enormous outsized amount of foreign exchange held by central banks relative to their gold holdings. And that probably precludes a gold standard too, as well. I tell the anecdote about, I guess, probably back in the 90s when there was a wave of people like Judy Shelton, writing editorials in the Wall Street Journal about how we should go back to a gold standard. And I asked the central bank, I was visiting one of our central bank clients, and I was in a room with several of their foreign exchange economists and such. And I said, what do you guys think about a gold standard? And they said, when we think about a gold standard, we ask ourselves two questions. How long would it last before it collapsed? And how much damage would it do to the real economy before it collapsed? And I won't bore you with the details, but those are the two key questions that the answers to which lead to a pretty stable conclusion that we will not return to a gold standard or a gold silver standard. I'm going to wrap up here. We've been on for about an hour and 45 minutes. I want to thank everybody for joining us again this year. There was one question about, are these regular events? We do these briefings when we release the yearbooks. So gold in March, silver in May, platinum group metals in July. We have open forums for clients of ours, including people who have joined via the retail investment project. We do these open forum question and answer periods quarterly for our clients. And then we have the Silver Facts and Fantasies open forum that we do every year before the PDAC. We've talked about doing others, but right now that's what we have. And you will get invitations to future events as they come about. Again, thank you, and we'll talk to you in a couple months.